Hi, everybody. Jim Kruzan here, and welcome to our halftime report. The data we're going to look at is current through the end of the second quarter, June 30th. As we do every quarter, we come up with a theme, and for lack of a better one, we will call this resilience in the face of turmoil and uncertainty. With a question mark, because we're not quite sure what the clarity looks like. So we're not going to be able to offer a lot of insight as to what the future will hold in store, but we can certainly look at where we are at this point and what has gotten us here. We do these every quarter because we think the economy matters. It has a huge impact on portfolio values, our investments, our retirement readiness. We will try to dissect several different important categories. We'll look at growth in terms of earnings as it relates to jobs and unemployment, corporate profits. We will also look at inflation as well as interest rates. We do all this in the attempt of getting a better understanding of where we are right now and also where we're heading. And to do that, we need to have two things right. We have to have a sense for where we are in this economic cycle. We are in a recession. We may very well be out of a recession here soon, but there's really no telling. And we need to know where the Fed is. And at this point, it's all hands on deck. They are certainly loosening interest rates and have made comments to the effect that we will be low for longer. So that's kind of where we are right now. That certainly is accommodative to the markets and economic growth. Our agenda is kind of compact. We're going to talk a bit about the pandemic, kind of what the numbers look like, what the trends look like. We'll talk about recovery and economic growth, at least to this point. We'll talk about the fiscal and monetary policies and the huge amount of stimulus that the government has thrown at this problem. And then we'll talk about equities and the need for and the continued need for sound diversification, especially in light of the uncertainties that we have today. So let's get right into this and look at the pandemic. This is an interesting slide. On the left, we talk about the U.S. cases to date, June 30th, and fatalities. Currently, there were 2.6 million cases. If you think about it, that's a huge number. When you think about it on a global scale, that represents a third of worldwide cases. And sadly, there have been nearly 130,000 fatalities. This is a major calamity. In the past, we've had flus before. On average, tens of thousands of Americans die yearly because of the flu. We've had pandemics before, and those numbers are certainly in this range. We just haven't seen anything quite like this in a number of decades. The chart to the right talks about changes in confirmed cases and fatalities. The blue line is cases. The brown line or dark gray is fatalities. And this is on a 7-day moving average. So we get a better sense for trend. And sadly, in both cases, after stopping a lot of economic activity, as we are starting to reopen, we're seeing some fits. We are seeing an increase on a rolling basis of confirmed cases. And sadly, we're also seeing an increase in fatalities as well. So this creates a lot of uncertainty as to just how quickly the economy does reopen, how quickly the various states go through their various phases of reopening. We may see us plateauing here for a while as opposed to advancing. Although no one out there today is expecting that we will have another major shutdown. The National Bureau of Economic Research produces this chart. Across the x-axis, we have dates. Currently, to the far right, and way back when to the far left, 1910 at the axis point. And on the y-axis, we have length of recessions in years. So this gives us a sense for how powerful this recession is as we talk about economic activity from peak to trough or loss thereof. And by looking at this, by the way, this recession that we're in, we'll call it the COVID recession, is that dark gray circle. Now, the size of the circle or the bubble represents the magnitude of the drop from peak to trough. And we'll see right now that this recession is the second largest we've ever had, second only to the Great Depression. In fact, it's larger than the recession that we had post-World War II. And what's interesting is look at how this recession, the sheer drop in employment, the drop in economic activity, how this compares to the financial crisis, which is that little circle minus 4% GDP, which is to the upper left-hand kind of quadrant from where we are today. So this has been a major recession. And while we are recovering and markets are recovering and we're looking kind of beyond, the fact is there's a lot of internal damage that's been done, and it's going to take a bit of time before those things really start to come back. This chart is what's called a high frequency activity chart. And what it does is it takes into consideration certain derivative activities to get a better understanding of kind of what's going on within various areas of our economy. So what this says is, look, not everything is as bad as it is, nor is everything recovering as well as every other thing is also. So we're looking at a chart here that tracks mortgage applications, U.S. seated dinners or diners, TSA activity, driving direction usage, flights, hotel occupancy. The two winners, the two that are kind of above the zero line, that's that x-axis, is mortgage applications, which are up quite a bit, 15% year over year from where we were a year ago, and also driving direction usage. So what they did is they determined, as a way of measuring the number of miles driven, the number of people who are driving, what they did is they looked at search engines, Google Maps, Waze, and other applications to see how many inquiries were there. And that number is 36% ahead of where we were just a year ago. So those are improving quite a bit. Sadly, things like TSA travelers traffic, things like U.S. seated dining, those still have a ways to go. And it may take a longer period of time for those to really improve. In fact, with U.S. seated dining, that is the number of seats occupied during dinner time frame at restaurants, that number is actually beginning to roll back over again, probably because of an upsurge in coronavirus cases. This chart talks about unemployment, and it's pretty ugly. If we look at the gray line, February of this year, we had historically low unemployment. At that time, we were down to 3.6, 3.7%, the best in over 50 years. And then immediately, within weeks, we went to 13.3%, actually nearly 14.5% unemployment. And that number's come down a bit. That number, the unemployment number, is actually 30% higher than it was during the financial crisis. And some of those jobs, especially the lower paying jobs, may not come back quite as quickly. An interesting derivative of this is the blue line. And if you look at that, you'll see, by the way, that tracks wage growth. And you'll see that's actually surged a bit. That's actually going up kind of parabolic, much like the unemployment. So that would imply wages are better. It's an anomaly. It's higher, certainly. The average is higher because we've wiped out a lot of the low employee jobs. So what we have left are core white collar salary jobs that skew that number a bit. Those lower paying jobs, some may or may not come back. The restaurant industry is saying, hey, we may see 20 to 30% of restaurants, current restaurants, just flat out not reopen. So there's some residual issues that will have to be worked out. Corporate earnings decline was significant. We've seen a huge decline in revenue. And when you look at kind of where we were at December versus where we are today, just about every category has seen some issues. Again, it's different depending on the industry. Utilities, technology, healthcare, holding up much, much better than, let's say, consumer discretionary or energy. Remember a few months ago, actually the forward energy contracts, the forward oil contracts, were actually a negative number. There was so much oil out there was no place to store it, and people were willing to walk away from contracts to take delivery, because if they had delivery, they couldn't do anything with it, and actually oil became negative for a split second per day. The other thing to consider here is the chart on the left, which is S&P earnings per share. Now, if you look at where we were in 2019, that's the last dark gray number to the right. And then we have 2020, 21, and 22, which are the blue numbers. The number is going to drop quite a bit in this year compared to last year. Also, there's a real good chance that we may not see earnings fully come back in 2021. It may be 2022 before we actually surpass the earnings numbers from 2019. And I think that's important because at this point, the market is reacting as if we're going to get through this and things normalize by the end of the year. I really don't see normalization until we actually have a vaccine, and we have the vaccine manufactured multiple times so that we have a dose for everybody. Then we see true normalization, and then we should see an abundant recovery. But until that point, it may be somewhat difficult sledding. The government has thrown a lot of money at this. When you look at GDP loss, first quarter, second quarter, that number amounts to about $2 trillion. Our economy is about $20 trillion of growth, actually about 22 trillion. So call it 5 trillion a quarter. And if the expectation is GDP contracted 30-ish% in the second quarter, 30% of 5 trillion is 1.5 trillion, and contracted about 4 or so percent in the first quarter, 4% of 5 trillion is 200 billion. We're looking at 1.7, 1.8 to $2 trillion. The government has thrown over $2 trillion of cash money at the problem. We're looking at another stimulus package that will be 1 to 2 trillion on top of that. Now we're talking about support for state and local governments. And on top of that, the Federal Reserve is backstopping bonds, backstopping auto loans, buying ETFs. They're buying securities, the same things you own in your IRA. They're buying bond-oriented ETFs to provide a tremendous amount of liquidity. And we're looking at a whole lot more stimulus in the future. This chart talks about inflation, and we have very little inflation. As of March, the headline number was 0.2%. Food costs have been rising. The premiums on getting food to the market and us paying for food on delivery is significant, but all those things are more than made up with really cheap energy. So the core PCE, which is the number the Fed looks at, is about 1% right now. That's down from about 3.3, which is the industry average. But a lot of what we're talking about, all this stimulus has in it a seed of inflation when the economy does recover in earnest after a vaccine. This sheer amount of stimulus that we have out there could very easily create a higher degree of inflation. So it's something that we have to certainly watch and watch closely for. The Federal Reserve has done a number of things. In fact, they have opened up their toolkit, and they are, as I said, buying bonds. They've also collapsed interest rates. Interest rates are between 0 and 0.25%. And the Federal Reserve has also been in print and very vocal about the fact that they plan on being lower for longer. Now, that's great for mortgages, home refinancing, auto loans, and all that will certainly help at some point. So the question is, with all this, it comes at what price? I mentioned $2 trillion of support. That number on the left, you'll see at the bottom, about $2.44 trillion of support, almost 12% of GDP. It's a huge, huge number. And as I said, it has inflationary tendencies, but also it has long-term ramifications. We're going to have to pay interest on this debt, even though interest is at historically low levels. Look at the chart on the right. In particular, the upper half of the chart, which talks about budget deficits. And you'll see how in 2020, the deficit is going to spike to a minus 18% of what we collect. Now that's up significantly from last year, which was only about 4.5%. So we were running spending at about 4.5% more than what we collected. This year, about 18% more. And that is going to be added on to our cumulative deficits, which we call national debt. That's the lower chart. And when you look at the Congressional Budget Office, which generally takes a more positive view of things, they're suggesting that our debt as a percentage of GDP, which was about 79% last year, will be nearly 100% by 2030. JP Morgan Asset Management is projecting out that it'll be more like 125.5% because they're expecting more stimulus over the next couple of years and a lower amount of tax revenue just because of lower profits and businesses in transition. At 125%, it becomes a big issue. A lot of our GDP, a lot of our excess capital that normally would go into reinvestment, some of that will be used for interest payments. So it dumbs down forward-looking GDP expectations. So we certainly have to look at that and watch that. Now, there are things that can be done to improve this. We could borrow over 50-year periods as opposed to 20, and at super, super low rates. That certainly saves cash flow, and that can help quite a bit. I mentioned just a moment ago about the debt and the amount of debt that we're generating here to stimulate the economy and combat COVID. Fortunately for us, we're at a time in history where interest rates are unprecedentedly low. Right now, the 10-year U.S. Treasury, which is kind of the benchmark security that we use to kind of gauge where interest rates are, was at a extremely low 0.66%. We've never seen that before. And in fact, several years ago, when I thought interest rates could go no further lower, I was certainly wrong. They have. The nominal rate, when you take into consideration inflation, is actually a minus 0.58%. Interest rates on a nominal basis, or on a real basis, I should say, are negative. Now, that creates a lot of stimulus, a lot of opportunity, and hopefully the government can take advantage of this by borrowing at rates that we will more than likely never see again. The Federal Reserve also has been very vocal about not wanting to take rates into the negative territory. Europe, other countries have done that in the past. most recently the last several years. And the U.S. Treasury would prefer not to, in part because they want to keep some powder dry should we get a double bump recession at some point. If rates are this low or worse yet negative, the only way they can quote unquote stimulate is to take them even further negative. But there's a diminishing marginal utility. As you move into negative territory, you don't get a lot of bang for your buck taking them any further. So this is a great time to refi. It's a horrible time to put money away in savings. And as a result, it creates a real search for yield. All right, so now let's turn our attention to the equity market. Let's see what's happening with stocks in the stock market. So this is a chart of the S&P 500. It goes back to 1995. If you look at what's going on here on the right-hand side, especially at the far right, you'll see a couple of things. Obviously, as earnings dropped and the stock market values have come back, the PE ratio has gone through the roof. In fact, at 21.7, it's well above the 25-year average of 16.3. In fact, it's a full standard deviation above that average. In fact, it's more than a full standard deviation above. And when you look at the ratios compared to 25-year average, you're also seeing many data points that suggest that the market is somewhat high. Now, obviously, if we get a quick snapback and quick normalization, then the market is not high. If it takes longer to achieve normalization, then perhaps the market is a bit high, and we may kind of tread water here for a while until we see an uptick. But the forward PEs are high. The Shiller PE, which is the cyclically adjusted PE, that's above historic terms. Dividend yield on the S&P below 2, 1.9. That's low by historic standards. The only thing that's still somewhat positive is if you look at the earnings spread compared to an investment grade yield, it's still positive. It's 1%. What that suggests is earnings in the equity market has given you, on a cost basis perspective, a better yield than investing in bonds. That is not indicative that the market is cheap. It's really indicative that interest rates are really low and there just isn't much of a yield out there. So that would look somewhat scary. I will tell you that when you have a sudden severe drop in prices and then a rebound in prices, but a lag in earnings, PEs for a quarter or two can be quite a bit higher than normal. And then they kind of best fit. So when we look at this from a cyclical basis and look at kind of a rolling 2 or 3 year period, it's not quite so high. Earnings will grow into these numbers, but it's certainly something to consider. When you look globally, there are still a number of areas throughout the world that are still dealing with COVID. When you look at the first chart, which talks about daily increases, again, this is a 7-day moving average. You'll see Europe has done a really, really good job. They have mandated masks. They've had a stronger stay in place. They are slower at reopening. And as a result, the case count has dropped and has stayed fairly low. When you look at Northern Asia, they didn't have nearly the same cases. When you look at things like North America, you will see our case count drop and then it's starting to tick upward again. We talked about that earlier. But in emerging markets, they're having a bit of a problem. Southeast Asia, as well as Latin America, those numbers are continuing to rise, which will mean globally, the emerging markets may have a bit of a problem in the near term. Once there's a vaccine, we're expecting incredible growth out of that space. The fatality numbers kind of show the same story. You're seeing still up until recently strong increases in fatalities in Latin America and also Southeast Asia. Those numbers, though, however, are beginning to drop or at least flatten out a bit. When you look at valuations, U.S. to international, and this is an old saw. I mean, the stark valuation difference has been this way for quite some time. There's incredible value from a price perspective in the world outside of the U.S. The world outside of the U.S. is trading at P's today, which are significantly below the U.S. Now, granted, they're still above the long-term average, but still way below. Dividend yields are a third, no, take that back, almost half again as strong. 3% dividend yields versus 1.9. So there's some real value there. The expectation is the next move up after a reopening, after normalization, you'll probably see the dollar start to fall. It's beginning to wane a bit. And that then moves the wind at the back of the international markets. Today in our portfolios, we have very little international exposure, but at some point, we certainly will more than likely increase that. The expectation is you'll see better growth, if for no other reason than mean reversion. So we'll want to look at that as well. And now this chart, when we look at this chart often, it's really a diversification chart. It's a reason for diversification. Look, nobody's got a crystal ball. I wish I did. It would make my life so much easier. Winners and losers change hands quite often. But if you take a generally balanced portfolio and make some adjustments on the fringes, you can achieve reasonably good return without taking this feast or famine, all or nothing approach. And in today's market, with the huge uncertainties, that makes the most sense. In our balance with growth portfolios, our larger IRAs that we manage a bit more tactically, we're using somewhat of a barbell approach. We have no idea what the future holds in store, but we have things that would be very sensitive to a quick recovery on days where it looks like there's a vaccine that looks promising. Small cap stocks perform incredibly well. And they not only perform well, but they perform at 2x the rate of the S&P. On days where it looks like the economy is going to have more of the same, and we're probably going to be working from home for a longer period of time, then a lot of those technology stocks that it did so well in April and May outperform the broad-based market on those kinds of days. So you've got two camps here. Those things that are very sensitive to a quick recovery, and those things that generally would perform well should the recovery take longer. And we have monies in both of those camps, and we'll make adjustments when we have better clarity, but we just don't have that at this point. I'll remind you, hey, look, we're open for business. And if you have friends, family, somebody who cares about who would like a second opinion, just a better sense for where they are, we'd love to be able to do that. We also have a report that we call the Retirement Readiness Report that kind of gives an individual an idea of where they stand relative to their retirement, and then what items or strategies that can be put in place, all for the purpose of improving probability of success. And we'd love to share that with people you care about. We use a very elegant wealth process. We call it our evolutionary wealth process that starts with a discovery meeting. We then provide some insight as to what can be done to improve the situation and also provide some clarity as to how the relationship would work. Third meeting is typically a mutual commitment meeting where, hey, yeah, we'd like to work with you, and then we'll figure out what paperwork or what agreements need to be drawn up. And then we work on developing and completing what we would call our advanced plan, which are all the punch points, the things that we know we need to talk about, the things we need to educate, the strategies that we need to have in place, all for the purpose of improving probability of success. And then we have a kind of an elegant process, which we call our maintain discipline process, which is the cadence of meetings, reviews. Are there changes in your life that would cause a change to the advanced plan or the cadence of our meetings, and on and on. So as always, we're here to serve. If there's anything we can do for you, any questions at all, by all means, reach out to us at www.kaydanwealth.com or simply call the office at 810-593-1624. Look forward to talking to you very soon, and we will do another one of these in just 3 short months. So take care, be safe, social distance. Thank you very much.